Good morning, everyone. Welcome to another episode of Capital and Context with myself, Mark Insley, and joining me, as usual, my colleague Samuel Hallett.
Good morning. How are you? How's being abroad?
Good, yes. As sort of we said last week, we were going to sort of do our first episode with split locations, so sort of testing the podcasting world and our ability to bring guests in and stuff in the future. But yeah. Cape Town is lovely. It's been a productive week so far. But yeah, good to catch up and do another episode. Good. So this week's episode, as we've sort of promised from sort of some prompts in previous weeks, is we're going to sort of focus on the much publicized and probably spoken about world of AI and how we feel that's affecting, in particular, investment markets at the minute. And, probably tap into both of our personal experiences of, yeah, how we feel it's affecting workplaces and efficiencies, and yeah, how we think it will shape markets in the years to come, really. So, um, yeah, Sam, if you could sort of open by, yeah, just setting the scene of, the role AI is playing in financial markets at the minute.
I think currently the core question is well, there's two core questions that comes down to this. Um, Anyone who holds a global equity tracker has circa 35% of US equity in just seven companies, which is up from 12.5% a decade ago. So anyone who's passive investing, has a huge allocation to Mag 7 and AI. I think the second core question is, looking at this year, we have an infrastructure spending this year alone is 700 billion US dollars that companies are spending, and that's enormous, and what that means for portfolios. And, I think one thing we're seeing this year is the Mag 7 is splitting into two kind of groups, which I think was quite obvious it would do in time anyway.
Okay. And yeah, just in sort of conversations and sort of general news, the DeepSeek question keeps coming up. So, for viewers, could you just sort of explain a bit more of the significance of that and why it's been spoken about quite so much?
Yeah, so it's quite topical at the moment, but I think we'll go back to kind of DeepSeek moment Mark One, which was last January. So DeepSeek, for those who don't know, is a Chinese company who are basically developing their own large language model. So large language model is your Chat GPTs, your Claude, your Gemini by Google. So it's like the first Chinese one, and the reason why it was a big deal was because it said that it matched the Chat GPT o1 model, which was the leading model at the time, at around about, they claimed, 6 million US dollars training cost. I think the real cost was close to 100 million, as is often the case with Chinese figures. Always take them with a rather healthy pinch of salt. But still, the thing about that is, Med's about what could you get out from AI with a much more efficiently trained model, let's say. That one day when that got released, Nvidia lost $600 billion of market cap in one single day. So that was a big deal. However, as we've gone through time, we've noticed that uh, the DeepSeek models take a bit longer to release. They're not quite as useful to real world applications as perhaps some other models. So yes, they are producing an efficient model, but its real world application at this point where we're seeing advancements in the LLM space so quickly, I think it's quite important to note that they're not quite keeping up. This month, DeepSeek V4 has been released, which has been described as like the DeepSeek AI Shock Mark II. Um, and I think the thing all around this is like, if you can build these things cheaply, why do the likes of ChatGPT, etc., need Amazon. Amazon. I'll talk about that in a minute. But why do we need $700 billion of capex when we can do this far cheaper? And it's about efficiency
Of
of
capital,
capital, really.
really.
Yeah. And another big name, Nvidia, I think reported its earnings this week, was it?
Last night, we're
Last night.
recording on.
Um, yeah, give what did we discover from that? Was that positive, negative?
I'd say it was positive, but this falls into what I was saying about the Magnificent Seven now separating into two groups. So you have Nvidia, and also when we talk about AI, you've got people say about TMSC. So TMSC are a chip manufacturer. They don't design the chips, but they make the chips. And Nvidia obviously is really big in the GPU space. That's graphical processing units. Ironically, it's not creating pictures. It's how it works differently to your laptop, which is called the CPU. But that's a whole not really relevant for this podcast. The what we're seeing is obviously there's all of this capex going on from what we're called hyperscalers. So that's your Chat GPT, Amazon, the people that are developing the product that me and you interact with, versus almost like the building blocks that go into that. So obviously the people that the capex is being spent on, Nvidia, their earnings are real and growing. They're still, the earnings are growing fantastically there. The question remains there is whether Nvidia growth can continue at this rate. We're probably peak capex, I would assume. I can imagine it will start to tail off just because we're now getting, capital expenditures exceeding free cash flow. So companies are now having to go out these hyperscalers out to the debt markets to which they haven't had to do for quite some time. So I think Nvidia is still looking good, and we participated through our passive elements of our US equity holding, but we deliberately diversified that away a bit so that we're not totally dependent on the 7 stocks that a normal passive holding would be.
But I think Nvidia is still going to prove its value in 2026.
And how are you currently benefiting your investment function and decision making, would you say, through AI? And and then secondary question, what plans have you got for 2026 to try to improve performance returns specifically from the use of AI?
Yeah.
So just from a portfolio perspective, what people see is our I say US AI because AI is more than just the US. You've also got within the emerging markets. So TMSE is based in Taiwan, so it falls under emerging markets. Similarly, Samsung, so the people that make all the memory that goes into these big, AI farms. It is made in South Korea, so again an emerging market. So the emerging market index actually has quite a bit of an allocation there. So we hold a bit there, both through our active smart GARP holding there and also through the passive fidelity index emerging markets. But in the US, our holding is mostly through the passive index S&P. The reason for that is that you've got an awful lot of exposure there just from that, and to hold a standalone on top of that, I think would be from a portfolio management perspective rather than an outright performance perspective, because obviously the thing about being a portfolio manager is that you have to bear in mind volatility within your portfolio. Is that it would be reckless to be overexposed beyond what the passive index provides at the moment.
Okay, so that's more a position about how are you using AI specifically for actually managing portfolios?
Yeah, so it's proving to be very, very useful. As you can imagine, we get an awful lot of
What's the risk? Yeah, what's the positive uses and the
yeah.
risk
So,
uses for people that want to use it for research, let's say?
So for research, what's great is obviously, so as we know in this space, we have so much information we have to trawl through. And what we're finding is that we can kind of put this all into AI models that we have been creating, and that it will isolate what are the nuggets in there that everyone else isn't necessarily talking about. And that's where we earn our money as portfolio managers. That is that we need to be able to pick up on things before other people pick up on them. The downside though is hallucination of AI models. So hallucination is when basically when AI models just start making stuff up in LLMs. It was really quite bad in a couple of years ago, but it's improving. It's still a factor, but it's still there. That can still happen. So obviously it's an input into our process. It's not the master of our process very much. We're not being replaced by an AI model just yet, which I think clients will be glad about. But I think due to the nature of it, there will always be a
Human in the loop, which I know is one of your favourite phrases at the moment.
No, it is. It is, and I'm probing and prompting, should we say? I shouldn't keep saying the word prompting, obviously, with it being an AI episode. But I was probably pushing you more for, let me, like Claude, for example. You're a big Claude user over ChatGPT. So if we can just move away from portfolios a bit at the minute to just more tools in the AI space that we feel are affecting portfolio management, could you just give viewers an overview of those two different tools and why you favor one over the other?
Yeah, sure. So ChatGPT, to be fair, if you're only going to be using one tool, when I say tool, I mean the LLMs. I would say ChatGPT is probably still your best balanced model that you can use out there. It's quite good at going through everything, but it's not exceptional at any one thing. Claude is really, really good at the more analytical and thinking kind of space. I call it more kind of more to how that side of my head actually kind of works. So I work with it quite well. So it's very good at research and report writing, but a technical report writing, and also make me think of ways that we can improve our processes. It's really, really good at that. The other one that I do use a little bit, that I would say you probably use ChatGPT for quite a bit. For those who don't know, Mark is a very avid AI user. I know you don't use it, and I can understand why. So I do use Gemini a little bit for when I need to write prose, nice, light and fluffy kind of things, which my head doesn't works a little bit more bluntly. So it works quite well at that. But I'd say ChatGPT works really well as a covers all, but it's not exceptional at any one thing. But it's a great tool generally. What about you?
Yeah, I mean, I probably am more of a purist on ChatGPT. I haven't moved off onto other platforms. But I think that's also because we have history, so me and ChatGPT. So it's very very knowledgeable and understanding on the business and me as a person. And I think that's what eventually adds power. That sort of like deeper understanding. So yeah, for me still ChatGPT. One thing I was going to ask an opinion on was I saw a picture or a video the other day in the kind of like battle between LLMs, where I think there was a group of like 30 people all holding each other's sort of arms are raised for a photo, but the Sam Altman and the owner of Claude Anthropics refused to even link hands. So sort of yeah, do you think that that's sort of the level of competition there is for there to be a market leader in this space, or do you think LLMs and the agentic industry will sort of go back to working together a bit more, because I feel like when this world was evolving, there was a lot more kind of unity and thought sharing and things like that. But it sort of seems to have got pretty competitive. And do you think that will be reflected in stock prices and things, I guess, as well?
So it's very hard when we're looking at the AI models themselves to when we're looking at stock prices, because ChatGPT is a private company. Anthropic behind Claude is a private company. So the only one you can really look at and is a little bit more transparent about things is Google with its Gemini model. But I think you're right in that things have got it was at a year or so ago. It was everyone's best interest to put forward a face of like, look, we're working together to be responsible and so on and so forth, as you said. Now I think, as I mentioned a minute ago, I think with these models going down a bit more specific use cases, people are getting a bit more protective about their sphere and wanting to dominate that sphere. The space is getting a bit more prickly. I think one thing that's been interesting in the news this week. So Pete Hegseth, who is the US Secretary for War, as they now call it, he's told Anthropic that they need to remove all of their AI safeguards or their ethics safeguards. Which says to me, okay, that's a bit worrying that the US Department of Defense is using, obviously, Claude an awful lot in operationally. So there's the ethics in behind that. And I think that's the area where you're going to be getting different opinions quite a bit and people getting a bit prickly over. Because obviously, as we unfortunately know, ethics being removed normally
means short-term wins on profit margins. So there's the temptation there.
Yeah. What do you think's changed from, let's say, November? What do you think has changed from November to now? I feel like in November, nearly every single client meeting I was doing, I was getting asked about the AI bubble, and yeah, I think we mentioned previously, I think we positioned well around that, and markets can continue to go up, and others, we're getting into panic mode and selling down to cash and stuff. What do you think's changed between now and November for that kind of obsessiveness around an AI bubble sort of disappearing a little bit? And yeah, sorry, always lots of questions in one, but
No,
do you think that talk will come back this year, or do you think it will be sort of, something that comes back onto the both investment agenda and client? Like, I was very surprised how many clients of different sorts were bringing these topics to meetings, which, as I've said before, I actually took as a contrarian indicator, and probably everything was gonna, do the opposite. Which I'm not saying it's done the opposite. I know there's been some
no.
pullbacks recently, but yeah, what's your general view of why that sort of tone of bubble has like?
Yeah, no, it's interesting you say about timing of retail opinions, because quite often when we we've got plenty of cases where we can evidence this, when people start getting very jittery is often the time when actually we should deploy. We've seen that several times, when you think back to COVID, etc., when people were starting to say, look, I want to come out of portfolios, that was the time literally to buy. But the difference is, so it's interesting, the things that are very much going on in the conversation right now. So as I said about CapEx, capital expenditure spending, and concentration risk, these are all, now they've gone through their free cash flow, so they're having to raise debt. These were all conversations that I think people more closer to the coalface were already bringing up around about April, May last year, and it's just taken a bit of time for things to ripple through. One thing that in conversation with my peers in other firms, when we've conversed on this subject, is that the AI space, so obviously the Mag 7 has had, compared to the S&P 493, so the rest of the S&P, has had a slower start to the year. but it's still having its earnings growth. What does that mean? So that means that the valuation multiple is compressing. So that's good there, which definitely needed to happen. We'll exclude Tesla from this conversation because that's a retail darling and it's not rational in its pricing at all. And not just that, there'll become a point when probably when we're coming up to the next earnings call, so that being roughly 2 to 3 months from now, when people go, hang on a second, it's pulled back, it's cheaper, but the earnings are still very much going on there. We're talking still about decent earnings growth. Across the Mag 7, we're still talking about 5% earnings growth over and above what the rest in the S&P is expected. So I think people will start clicking that, okay, earnings will come still going good. You go where the earnings are.
Okay. And again, just because I'm enjoying the AI theme, what's some other AI sort of, probably more smaller scale startup companies that, that you think viewers could use work into their lives, you can give to and I'll give to.
Oh, I'd say you're probably best to answer this one due to the fact that obviously those kind of size firms are too small for me typically, as in to invest in. Go on, Ed.
Off the top of my head would be Otter that I use primarily on drives and walks down the road, walks down Sunningdale High Street, trying to maximize my time massively. And for me, yeah, as a transcription tool to collect my thoughts to put into other means and practices, I find Otter the best on the market for that in terms of an audio transcription and storage and the accuracy of that. So yeah, just that sort of thought collection process. I really like that as a tool. And then I'd probably say as a sort of all-round agentics tool, where if we break away from just straight pure AI to agentics, which is maybe warrants its own episode separately. I really like a tool called N8N. So yeah, N number 8N, which is a whole library of mainly AI driven business integrations that paired together can do amazing things with data, transferring it to social media clips to whole podcast episodes. I've seen whole podcast episodes, sort of almost audio recorded. Some incredibly powerful stuff there. And again, yeah, just tool is for me. It's the number one tool for the agent building space for those that want to get that into AI.
I think this is you're going to be happy that I'm saying this. It's not so much. Oh, well, it depends on what you want to call the size of company. I would actually say the software that our in-house team has been producing over the last year or so has been rather incredible. And I say this from a more middle office kind of perspective, in the sense that as much as obviously we try to minimize human errors, obviously human errors are going to still exist. And with AI, because it's it's so good at being able to do those more process driven kind of elements within tasking, you reduce the likelihood of human error coming in, and things become obviously we are compliant, but the risk of non-compliance comes right down. And I think that's really, really important. I think also one thing that's also changed up how more efficient we are and how much more we can do fund manager meetings and have those conversations is so actually, as you said with Otter, I need to convert over to Otter. I'm still in essence several generations back with using Read.ai, which is a similar tool, just nowhere near as advanced. But when I started using that within fund manager meetings and just being able to get those transcripts and then being able to summarize them, and through how it monitors my face, looking at how I react to, unfortunately, as such people in the office will tell you, as much as I try to have a filter, my face stops my filter working, and what I'm thinking very much comes out. So it picks up whether things that I think this fund manager said were interesting, and I think that's proved to be really useful actually for ourselves.
Yeah, agreed. Um, yeah, and I guess sort of going to those fund manager meetings, then do you feel tones of those meetings have sort of turned, and do lots of those meetings sort of get dominated by talk in this space, or is it sort of been and gone and you're kind of back more to macros and sort of general growth topics and things like that? How much on a day-to-day basis does this sort of steer the course of a meeting you're having?
So yeah, this is now, I'd say it changed an awful lot around about the middle of last year. So up to that point, everything was, trying to make, say about where they got AI in their portfolios, in that whole aspect. And then we came around to the end of September, October conference season. You tend to have two fund house conference seasons. One's around about March, April, and one's September, October. And the ones around September and October, on a panel was a tech fund manager who I respect very much. I've never held their fund, but I respect their opinion an awful lot. And when a tech fund manager even starts to say the word bubble, that sentiment is changing. I think actually the way the market's acted since has averted a bubble occurring. And I think that the market, as I said in quite a few client meetings last year, I was saying that mid 2027 I think is going to be when the party stopped with AI. I think the markets have been more rational since then, and we might just end up with an earnings compression, valuation multiple compression through time, but earnings still be good, which I think would be excellent. The only thing is whether you get the debt for some companies. So, for example, Oracle has spent a huge amount on GPU chips, but is issuing like 20-year, I can't remember exactly, but bonds that are much longer than the useful lives of GPUs. And it's the fact of whether that's sustainable, because obviously if you're going to have to replace the GPUs but you haven't paid off the debt that you took up for the last lot, how sustainable is that in the long term? So I think some of those companies that still in a couple of years might be vulnerable. But I think as a broad market, I think things are looking a bit more healthy than they were perhaps 6 to 9 months ago over the more medium term.
Okay. And kind of moving on back to you, we've sort of spoke quite broadly about the big marketplace for AI, which is in the Mag 7, and how they have to include it in their models to stay relevant. We've tried to give a bit of variety by bringing it back to sort of more granular day-to-day tools that we see useful, and how others might apply it. So I think sort of the last sort of section to cover in today's episode is execution. If you were if I mean, I guess wherever you hold in the world you feel you've got some exposure to AI. It doesn't really matter if you're holding a European fund. I mean, I guess probably you can differentiate in that I'm sure there's European funds that are more tech and AI focused than others. So you probably pick up a more natural uptick, or you go into a more traditional banking and non-tech driven fund. But sorry, long-winded answer to my question is, do you have any, any thoughts around investment trusts and ETFs where you might go, directly really into the AI sort of mid cap space, I guess? Are those sort of opportunities available, or are those sort of funds still being talked about, or perhaps available in the US market and not available for UK fund management?
So that's an interesting one because the US has, unfortunately, the name of the structure eludes me, but the US has a legal structure which permits, in essence, they list a company with a large cash balance when it actually is a company of nothing, and then they buy companies into it. It's just kind of like an investment trust, but it's but obviously investment trusts, when they start, have seed money and have already got a portfolio before they even list, whereas theirs are almost removing the seed money element and just creating a blank company. Those kind of companies obviously we can't hold, but they end up with quite a bit of exposure on the more private side of things, which I think is possibly quite interesting, but not necessarily something that we could get over here. Obviously, the thing with ETFs is that you're looking at everything at a market weighted basis, and I don't necessarily think that's going to be the best way now to play things. I think we've kind of run towards the end of this being just a momentum style play, which is when ETFs and passives work really well. So I think you want to look at slightly more alternative structures, as you said, like an investment trust. We're probably more likely to play out better in a more medium term if it's run well.
Well,
Okay. And sort of in terms of, like, let's just say our benchmark constituents being the pool of competitors, like from your appraisal of those benchmarks, are there any of those houses you feel that are tilted more in this direction and, would do better or worse in a bubble, non-bubble scenario? Like if we sort of went down to those sort of benchmark constituents.
Depends which part in the bubble. That's the thing, isn't it? After all, people. You,
If we had a bubble, which of those houses do you think would do well because they haven't got much exposure? Let's sort of word it that way.
yes. So you want to be looking at those fund houses that tend to have more value specialism. So Ballygifford has very much a growth kind of style, which means that they're quite exposed to shocks of this kind of nature. Obviously, they might outperform, but I don't want to end up getting a libel action against us. Phantasms that would work really well. I would actually say someone like Artemis with the smart graph. Sorry, I know I keep on mentioning about the smart graph on these. I will mention other funds at some point, but they've worked really well lately because, as I said previously, it's growth, but with a value overlay. So it's making sure that you're not overpaying for things. So I think that is possibly the right way to go at this stage, and hence why we continue to hold them in certain markets. Don't hold them for the US though. So, Mark, is there anything else on your mind with AI that you'd like to
yeah.
discuss?
That's a very generic question. For me, the space is very, very, very exciting. Yeah, researched it a lot, had wins, had losses. But yeah, ultimately, I think it's here to stay. I vehemently believe this is a generational shift in how we think, work, and live, and that's very scary for some people. But I feel we're already there. So yeah, I think we work and live with have connections to people that are probably above average users, but for those not on their AI journey yet, if you like, would encourage everyone. Yeah, would encourage everyone to embrace it. The way I see my 9 and 7-year old using it, kind of make. I mean, maybe I'm a odd case, but yeah, the way they're already using it, I think to me sort of shows that it's one of these things to you know either ignore completely and live a life away from news and technology and stuff, but unfortunately, not many people get the luxury of that. So I think in embracing it, is the way forward. And as I say, like I haven't actually moved off ChatGPT massively. So yeah, for me, anyone looking to learn more about the space is it's it's a good starting point. And I think my number one AI tip is, as much as it might feel unnatural, as much as it might feel a bit weird in the first weeks and months doing it, but talk to AI. And I learned this off my 9 year old. My 9 year old was having quicker, faster conversations by talking because he didn't want to put himself through the pain of the typing. And again, I think as a user, it pushes you to a whole new level when you get the confidence to talk and record into LLM. So that's my snippet of advice to everyone. But yeah, I'll
Yeah.
I'll I'll,
That,
I'll keep it short there. Otherwise, um we'll get into a very long conversation. So that's my snippet of knowledge.
That is interesting. It's interesting what you said there about it's a generation on, and it's something that I was thinking about over the weekend. So if we go back 30-ish years, and when I'd say when, or possibly, basically when we ended up with things becoming a lot more computer led, etc., and we ended up with that generation that struggled to adapt. But when I say generation, I don't necessarily mean old. I mean as a cohort of people, and I wonder whether we're going to have that occur again with AI and a group of people that struggle a little bit more to adapt, but also those people who struggle to adapt to the last generational change, I think, are going to be completely lost potentially with this, and that's quite scary in some ways. It creates opportunities in others, as you would expect, but the other side as well is when you're saying about ChatGPT, they very much, I think, have the early supplier advantage. And you're very much an example of this. They were very much the early forerunners. Well, still are forerunner in terms of number of users. That the early adopters, people, and let's be honest, you've created quite a lot of business processes that involve ChatGPT. Not front client facing necessarily, but more in the middle office. And you don't want to change what software you're using. So if you've made all your processes already with ChatGPT, you're not going to then change over to a new model. It's too much of a pain. So yeah, I get that completely. That's
that's
an
an
advantage
advantage
that
that they
they'll
will
have
have
for
for
some
some
time.
time.
Yeah, and I think that will be reflected again in brand loyalty, just like there's brand loyalty to Nike or
Yep.
or something like that. So yeah, when all these companies do get listed, I think it will be an important point in the valuation factor and yeah, how we use those in the funds and stuff. So yeah, very interesting topic, but yeah, fairly long episode already. So I think we've reached our 30-minute level, as I feared we would do on this episode. So yeah, that's all from myself and Sam for this week. Yeah, as ever, comments and feedback are great. I think the audience is slowly growing, so that's good. But yeah, again, we appreciate everyone that's listened to the end, especially. So we'll catch up with you again next week.